Did you know that one simple choice you make today could save you, or cost you tens of thousands of dollars in taxes down the road? I'm talking about choosing between a Roth IRA and a traditional IRA. A shocking number of Americans pick the wrong one, and it can have a huge impact on their retirement. But don't worry, we're going to fix that right now. Stick with me for the next few minutes, and I'll break down everything you need to know to make the best decision for your future. First off, let's get the basics straight. What exactly is an IRA? The letters stand for Individual Retirement Account. Think of it as a special savings account designed to help you invest for retirement with some awesome tax benefits. It's not an investment itself, but rather a container where your investments can grow. The two most common types of these accounts are the Traditional IRA and the Roth IRA. They both help you save for the future, but they do it in very different ways, especially when it comes to taxes. Let's start with the one you've probably heard about the most, the Traditional IRA. The big appeal of a Traditional IRA is the potential for an immediate tax break. When you contribute money to a Traditional IRA, you might be able to deduct that amount from your taxable income for the year. So, if you put in $6,000, your taxable income could be $6,000 lower. This means you pay less in taxes today, which is always nice. Once your money is in the account, it gets to grow tax deferred. This means you don't pay any taxes on the investment gains, dividends, or interest each year. Your money can compound and grow much faster without the drag of annual taxes. Sounds great, right? But here's the catch. The taxman always gets his due. When you retire and start taking money out of your Traditional IRA, every single dollar you withdraw is taxed as ordinary income. So, you get a tax break now, but you pay taxes later. Another thing to keep in mind is that the government won't let you keep that money in there forever. Once you reach a certain age, you'll be subject to required minimum distributions, or RMDs. This means you have to start taking money out and paying taxes on it, whether you need the cash or not. Now, let's flip the script and talk about the Roth IRA. The Roth IRA works in the exact opposite way when it comes to taxes. When you contribute to a Roth, you're using after-tax dollars. That means you don't get any upfront tax deduction. You've already paid taxes on the money you're putting in. This might feel like a bit of a downside at first, but this is where the magic happens. Once that after-tax money is in your Roth IRA, it grows completely, 100% tax-free. Every bit of interest, every dividend, every single dollar of capital gains, it's all yours. And the IRS can't touch it. And the best part? When you retire and start taking money out, it's all tax-free. Yes, you heard that right. All those withdrawals in your golden years are yours to keep, with no tax bill attached. Imagine having a huge nest egg and knowing that every cent you pull out is pure, tax-free income. It's a game changer for financial planning in retirement. Plus, with a Roth IRA, there are no required minimum distributions during your lifetime. If you don't need the money, you can let it keep growing tax-free and even pass it on to your heirs. So, let's do a quick side-by-side recap to make it super clear. With a Traditional IRA, you might get a tax deduction now, but you pay taxes on your withdrawals in retirement. With a Roth IRA, you get no tax break now, but your qualified withdrawals in retirement are completely tax-free. A Traditional IRA is best if you think your tax rate will be lower in retirement. A Roth IRA is best if you think your tax rate will be higher in retirement. The core question is, do you want to pay taxes now, or do you want to pay them later? Now that we understand the mechanics, let's talk about the common mistakes people make when choosing. The biggest one is simply following what their friends or family are doing, without running the numbers for their own situation. What is right for your buddy who is a high-earning surgeon might be the complete opposite of what is right for you as a recent grad just starting your career. Another huge mistake is ignoring your future potential. People often look at their current income and think, I need the tax deduction now. But they fail to consider that their income and, therefore, their tax bracket might be much higher in 20 or 30 years. Paying taxes now while you remain in a lower bracket can save you a fortune, compared to paying them later when you remain in a higher one. A third mistake, and this is a big one, is opening an IRA and then forgetting to actually invest the money inside it. An IRA is just the account, the bucket. You have to choose the investments like stocks, bonds, or mutual funds to put inside the bucket so your money can actually grow. Just letting cash sit in an IRA is like buying a race car and never taking it out of the garage. And finally, the most common mistake of all is simply waiting too long to start. The power of compound interest is your greatest ally, and the longer you wait, the more of that power you lose. So, how do you make the right choice for you? It really boils down to your personal financial situation and where you see yourself in the future. You should seriously consider a Roth IRA if you're early in your career and your income is relatively low. Your tax bracket is likely the lowest it will ever be, so it's the perfect time to pay those taxes now and enjoy tax-free growth and withdrawals later. If you expect your income to increase significantly throughout your career, the Roth is almost always the better choice. Locking in the tax-free status while you can is a massive advantage. And of course, if the idea of a completely tax-free stream of income in retirement sounds amazing to you, the Roth IRA is your ticket. On the other hand, a traditional IRA might be the better fit if you're currently a high-income earner and are in your peak earning years. The immediate tax deduction can be very valuable when you're in a high tax bracket. This can lower your current tax bill, freeing up more cash to invest or use for other goals. You might also choose a traditional IRA if you expect your income, and therefore your tax rate, to be significantly lower in retirement. For example, maybe you plan to stop working entirely and live a more modest lifestyle. In that case, paying taxes later at that lower rate could be a smart move. Ultimately, there is no single perfect answer that applies to everyone. It's not about finding a secret formula. It's about making an informed decision based on your own life. Don't base your choice on a guess or a hot tip from a friend. Look at the IRS rules, consider your current income, and make an honest projection about your future income and tax situation. That's how you make a decision that can set you up for a comfortable, financially secure retirement. It's your money and your future, so take the time to get this right. I hope this breakdown has made the Roth versus traditional IRA debate a lot clearer. If you want more simple, honest money advice that's easy to understand, make sure to subscribe to Dollar Wisdom. We're here to help you navigate the world of personal finance without all the confusing jargon. Thanks for watching, and I'll see you in the next video.